Very good morning to you. Welcome to today's webinar, Legacy, Charitable Giving, and Philanthropy, presented by Elville and Associates Managing Principal and Lead Attorney Stephen Elville. My name is Jeff Stauffer, Community Relations Director with Elville and Associates, and I'll be your moderator for today's presentation. We appreciate those that are new to our Elville webinar series and are here for the first time, and also to those that are frequent attendees. You're in the right place. We encourage your general questions today, as always, and so please note them in the questions panel on your screen. We'll pause periodically throughout to address them. Your questions really help the presentation and add value. They help others learn, so don't be shy in posing your questions at any time. You also received the presentation slides by email this morning that Steve will be referencing, so please be sure to reference those and take notes if you wish. The slides are also available in the section marked handouts on your screen to download at this time. For our professionals on today's webinar, welcome to you as well. 1.5 continuing education hours are available for most everyone in attendance. So if you'd like to submit an ID number and your accreditation for me to provide a certificate of attendance or submit your information to the CFP Board of Standards, please send that information to me today if I don't have it already. Everyone will also receive a post-webinar feedback email right after the presentation, and we ask that you please just take a couple minutes to fill out this very brief survey to offer us your feedback about the presentation. And we read and value every comment, as always. And here at Elville and Associates, we always want to be a resource to you for your families and your planning needs, whatever that may be it for charitable giving, estate planning, elder law, special needs planning, whatever the matter may be. Consider a consultation with Steve after today's presentation. Use today's information or any of our other webinars information as a jumping off point to get your planning started. They're a great way to get your specific questions answered, have Steve understand your individual and specific situation, and help create a path forward for you. So before we get started, we're going to offer just a brief introduction about the firm and give Steve a proper introduction as well, and then we'll get started. So Elville and Associates, we were founded in 2010 by Stephen Elville. We have several different practice areas that we focus on here at the firm on a daily basis, including estate and special needs planning, elder law and elder care planning, estate and trust administration, business law and succession planning, guardianship and litigation, tax planning and asset protection. We have 9 attorneys, 12 staff members, and 5 locations. Steve and I are coming to you live from the Columbia Gateway Community location, which we've been at for 4.5 years at this point. Our mission, as it always has been and always will be, is to provide practical solutions to our clients' needs through counseling, education, and superior legal technical knowledge. And we do focus on education a lot here at Elville and Associates. We do that in several ways, namely through our planning processes with our clients. We offer many, many educational webinars and workshops in the communities that we serve each year, and also by way of our accredited client care program. We are one of only 2 firms in Maryland to have an accredited client care program through the Client Care Academy in Boston. And we also work with the ideals of client education, collaboration, and compassion in mind with every client every day here at Elville and Associates. Just a bit about Steve. His work as an attorney for the past 23 years has been centered in elder law, special needs planning, and estate planning, with an emphasis in the areas of tax planning and asset protection, among many other areas. A member of many different and national membership organizations and professional organizations, including the National Academy of Elder Law Attorneys, the Academy of Special Needs Planners, and a national network of estate planning attorneys. He works to bring peace of mind to clients by offering solutions to their needs through counseling, client education, and the use of leading edge legal technical knowledge. A very seasoned speaker, if you haven't heard Steve present before, each year offering many webinars, workshops for businesses and their employees, conferences, and continuing education events. Steve was also named to the Maryland Super Lawyers list for an 8th time in 2023 and a 7th consecutive year. So congrats to Steve. We'll see what 2024 holds for us here. He also had a feature story written about him in the National Secret Lawyers magazine about the Elville Center for the Creative Arts, which is our firm's charitable organization he founded in 2014, and I'm very privileged to be the executive director of. If you'd like to learn how we work to make a musical difference in the lives of children each day, I would love to share our story about the Elville Center with you when we have just a bit more time. Please feel free to reach out to me about that or anything else that you may need. But for right now, we're going to talk a little bit about charitable giving and philanthropy, one of the most widely requested topics in our webinar surveys that we send out. When we ask about what you'd like to learn about, this is a topic that you continually bring up. So here we are today. You ask and you receive, right? So Steve, I'm going to make you the presenter.
Thank you very much, Jeff. Thank you for that. And I'm going to show my screen. I'm going to get my presentation up, hit the slideshow, and we'll get started. And thank you so much, Jeff. Good morning, everyone. I'm coming to you, as Jeff said, from the Columbia Gateway location, Conference Room 1 here at Elville and Associates. And I just feel really privileged to be with you. I hope my voice will hold up throughout the presentation, but I've got plenty of water here. And I want to thank you for being here, for spending your incredibly valuable time on a Wednesday morning with us. Jeff, thank you for all you do. And without you and without Jeff and all of the associates and attorneys here at Elville and Associates, I would not be able to do what I do. I also want to make sure that before I end today's discussion, I'm going to be talking with you about our special counsel attorney, Charles Borick, who and his law group, which is called the For Purpose Law Group, that are a big support to Elville and Associates in helping our clients with their charitable and charitable giving and planning. So it's with great honor that I'm with you here this morning. And I'm also honored because just for you being here today, it shows me that I'm in the company of very caring, compassionate people. Even the financial advisors and CPAs that may be on the Zoom call here this morning, we are driven by something that brings us to this particular subject. This wonderful positive discussion about helping, being there for others, being there to further a cause or a conviction or a compassion, driven by love, driven by passion, whatever it may be. So it's just a really powerful place to be this morning here with you. And we have one major goal, maybe two major goals in mind this morning. We're going to give you the tools that you need to be able to think through these issues. I want to give you the framework, give you the tools that we always try to do in our webinar series, but I also want to give you the ability to move forward with that and to be able to get to the next step. One advisor told me a long time ago, Steve, we really love and appreciate your educational approach and all the people at Elville and Associates who believe in that. However, without a path forward, without organization to the idea of education, it's not going to get us to where we want to go. So we want to give you the tools, the framework, and a path forward. So we're going to be talking about several concepts this morning. These are going to be very non-technical in some ways, concepts, and technical in other ways. And I'm going to be asking you some rhetorical questions where we're going to have you be interactive if you're feeling up to it this morning on a Wednesday morning. But we're wanting to get your reactions. Whether you share them or not is up to you. Some of you will have wonderful thoughts and ideas that you'll write down on your pad or your iPad or your tablet or your telephone or your phone, I should say, or your plain old pad of paper. Whatever you have in front of you, we want you to be busy. We want you to be thinking. And along those lines, I think I'm just going to start, Jeff, with an informal poll. So I want to take about 60 seconds as we get started here and just ask, why are you here today? I'm going to ask some other questions as we go along, but each of you have an idea, I think, of your interest in charitable or legacy planning. And I want you to just either think to yourself or share it with Jeff in the chat if you feel up to it and are so desiring to do that. Let's think for the next 60 seconds, why are you here today? What is your interest in charitable planning? What is your interest in finding out how to do it? finding out more about it, finding out more of how to get from point A to point B with it. What are the various aspects of it? What are your thoughts? And these are very personal to you. We'll go for about another 45 seconds. Many of you are already very charitably inclined, very generous. Many of you have patterns of giving already. But as you sit here today listening to this on a Wednesday morning when you could be doing anything you want to do, what is it that's brought you here today? All right, we'll go about another 10 seconds. All right, so we're almost done here. My trusty timer says we've gone 60 seconds. And if you want to share any of those thoughts, please do with Jeff. He'll interrupt me here in a few minutes, but I'll keep going in the interest of time. And if you don't feel like sharing, that's perfectly fine. But I wanted to set a mental framework of where we're going here. Of course, this particular presentation is educational only, and we are not meeting in person, and we're not really meeting in an attorney-client relationship, but we'll talk about that later. But this is obviously very strictly high level, and it's educational. So today we're going to be talking about what do we do with client and family education for philanthropy and for charitable giving. And what is philanthropy? We're going to be talking about that. And we're going to talk about why do donors give to charity or to charitable causes. And some of you just answered those questions for yourselves right now when you just did that little poll. We're going to talk about the various approaches. But you see in those first 3 or 4 bullet points, we're talking about the why. We're talking about, why do we do this and how do we think about it? You see, the mechanical part of it is easy. The mechanical part of it can always be accomplished, but we're trying to establish the real why. What are the tax advantages of philanthropy? And surprisingly, you're going to find out that the tax advantages are maybe not at the highest priority for most of you or for most people across the country that do planning. We're going to talk about how to be creative with planning, or we're going to talk about keeping it simple, as some people would say, hey, that is the cleanest and safest thing to do, to keep it simple. And then we're going to talk about that part, what I mentioned earlier about not only having the education and the tools and the framework, but how to get started with it and where to go next with your thoughts and your compassion about giving. This is just a little quote by Andrew Carnegie that I thought I would share with you. You know, one of the wonderful things about the creation of wealth in this country, and whether or not you feel that your wealth has really proliferated over the last several years, but I think most of us in estate planning and most of us probably on the call here that are financial advisors or CPAs would agree that there's been a great amount of wealth created in this country in the last several years. And, it's from that wealth that we are able to stand back and say, how can we benefit our fellow man, benefit our world? And I know many of you feel very, very deeply about that. So what is philanthropy? Let's get right down to the Webster's dictionary version. I know there's many dictionaries. Well, we might say goodwill. It's goodwill to the fellow members of the human race. And an active effort on your part to promote this welfare. So see, by you being here today, you're being very proactive. An act or gift done for humanitarian purposes. You see that human welfare, human race, humanitarian, it's coming up here in this word over and over again. An organization distributing for or supporting the funds for humanitarian causes. So really drilling right down to the fundamentals. This is about, at least according to Webster's, this is about benefiting the human race and humanity in general. Now, just taking off a little bit further on that, big-heartedness, bountifulness, generosity, unselfishness, munificence. These are words to get in our minds about what we're doing, because this is not the norm. This is not the norm. You being here this morning talking about charitable giving is not the norm. We do thousands of wills and trusts, and we've seen hundreds of thousands of documents over the years, and very few of them overall provide for charitable giving. But of course, some do. But I'm saying overall, it's not a great majority of the documents. So the fact that you're thinking about planning, the fact that you've either done planning before, you are in the minority of people, and you should recognize that, and you should congratulate yourself for all of these things that describe you and your philosophy about giving, because that is a rarity. Now, I'm going to stop in just a second and see if anyone shared their ideas or their philosophy today. But why do people give? Well, you have your own reasons. We're going to talk about that in just a second. But generally, it's a desire to help others. Obviously, we just talked about that. But let's get down into it a little bit. A belief in a mission, okay? It's a belief in a mission. It is trust in a mission or an organization that you believe in, okay? It is the experience that you may have had or that you will have in making an impact, okay? And that impact may be just financial from a distance, or it could be a personal connection that you have. And many of you have this personal connection with a charitable cause or your church or whatever it may be. And then lastly, as you see here, it's the tax benefits. So that may be surprising to some of you, and that to some of you, it may not be surprising at all that the tax benefits just happen to be icing on the cake for some of you. So Jeff, I'm just going to stop for just a second and see if anyone shared why they are here today, and it's fine if they didn't, but I just wanted to see if anyone had.
Thanks, Steve. We do have a couple attendees that did share, and we do have one question that I think is good to pose at this time. So first and foremost, one person said, establish and operate a foundation for IDD adults.
Wonderful, thank you.
And the next one is, I plan to leave my entire estate to charities.
Wonderful, wonderful. That's fantastic. Thank you for sharing. That's very helpful.
And so we have a question. It says, what are the advantages of giving to charities before end of life as opposed to giving after death?
All right, that is a great question. Thank you for that. So what I hope to do in this presentation is answer some or all of that question, because giving during life will, even though it's on the bottom of the list here, give you some tax advantages. It may give you tangible evidence of your ability to enjoy the gift. See, you see, estate planning and charitable giving is not just technical, and it's not just about documents, but it's about an interaction. It's a human interaction between you and the planning, and you may choose to enjoy the fruits of your gift, to be able to see the results of that, to be able to, for some of you, be recognized for that. Now, some of you may be very, very generous and say, Steve, I don't care about being recognized, but I'm going to give you an example of why recognition can actually help the charity or your cause to raise more money. So I'll give you a few examples of that. So one of the reasons, or two or three right off the top of my head, that might be reasons to give during life is not only current income tax advantages or estate tax charitable deduction advantages during life that will eventually take place at death, versus leaving these gifts later where there are certain tax advantages, and that includes income tax and estate tax later versus earlier. So I guess it's just going to depend on the situation and what your goals are. So that's another thing I want to do now, is really just take a few minutes, maybe another minute I should say, and I'm going to start my timer here. And I want you to not only ask yourself, like some of you did, it's a similar question, why am I here? You answered that, thank you. But why do I want to give? Why do I want to give? This is a different question, the one that we're looking at right here. So let's take 60 seconds here on that, and we'll be very interactive, very brief, very efficient, but we're going to ask ourselves, why do we want to give? Is it one of these 6 bullet points, or is it a different one? What is our motivation? Are we giving because there's been a pattern of giving in your family history? Are you giving because charitable causes have helped someone in your family? Are you giving because there's really your particular situation, there's no other persons to give to, and you're very charitably inclined? We're going to go for about another 30 seconds on this and let you just rhetorically ask yourself this question. Five more seconds. All right, my timer has just gone off. Thank you for participating in that, and I want you to keep that private. I want you to keep that to yourself and maybe help you to identify what your purpose is in giving. Some of you already know that. Some of you are exploring around the edges of charitable giving, and hopefully the tools here this morning will help you think through this further. Now we're going to get into more material, and we're going to get into the mechanics here. How do we do planning at a very high level? But I'm going to stop again because those of you who have may have ever been on our webinars know that I'm a big believer in drilling down into the fundamentals before we get into the technical. So I want to lay the foundations with you for a few things. I want you to ask yourself, do I have a current estate plan? And how would my charitable giving revolve around that current estate plan? And does my current estate plan need to be reviewed? So that's just kind of getting to the mechanics of it. But what I'm really talking about is, what does your current estate plan say? Even though that's not the only way to give charitably, is through an estate plan. But I want you to think about, what is your current estate plan and when was the last time it was reviewed? I also want you to think about something I'm going to call the planning team. We at Elville and Associates are big believers in collaboration. There's a very, very big world, as you know, of financial advisory firms. Some of you have financial advisors. Many of you do. Most of you do, probably. Some of you do not, and you invest independently. Whether you have one or not, we're going to recommend that you have a planning team. Why? Well, when you have an estate planner or an estate planning team, and when you have a CPA, a tax team, and when you have a financial planning team, a financial advisor that is part of this advisory team, that is the beginning of success right there from the point of view of you being advised at the highest level. Now, we can keep charitable planning and giving very simple, very simple. But there are elements of it that you're going to need advice about. And my assumption is many of you on this webinar this morning are very sophisticated people who already have an advisory team. But if you don't have an advisory team, I'm going to strongly recommend that you help yourself to find one, or I can help you, we can help you find one, because we want you to have that team. That's number one. And number two, we want you to have a team that actually talks to each other. So whoever those advisors are that you feel that you're best served by, we want those people to be talking. Now, if you are going to be doing charitable giving, do you want to be advised at the highest levels? And I think the answer to that question is yes. And to my mind, the only way to do that is to have an advisory team, because no person, whether it's me, another attorney, a CPA or an advisor, no one of us has all of the answers or all of the perspectives about planning. So whether we're doing planning that's charitable or whether we're doing routine estate planning or other planning, we want to have that advisory team as a conceptual, perfect kind of organizational structure for ourselves. And we want that team to be talking to one another in your highest and best interests. So that's one of the things I wanted to bring to your attention. The other thing I want to move into now is to just give you a framework of how wills and trusts work. Now, again, there are ways of giving charitable gifts, which we're going to talk about here in just a few minutes, that have nothing to do with wills or trusts. But when we're talking about wills and trusts, which is leaving assets at death to someone who, or an organization that is charitable, we are talking about 4 elements of a will or trust. And for those of you who are writing this down, I'm going to let you have these 4 bullet points. The first one is, who gets tangible personal property. My furniture, belongings, jewelry. Could be boats, it could be a car. Second thing, and this is a big one now, who gets special or specific gifts? So in your will or trust, this second piece in my mind would be what I would call specific gifts or special gifts. This could be gifts to a grandchild. It could be a gift to your church. It could be a broader charitable gift to another organization or to several organizations. Thinking of this as kind of an off-the-top gift, okay? The third element in an estate plan is what I would call the balance or the residual estate. So that residual balance of your estate, that can also go to charitable causes. One of our participants here this morning said and shared that he or she is going to give all of their assets at their death to charity. So their will or trust, if I assume they have one, the balance in that residuary portion is going to go to charity. So just wanted to throw that out there for those of you who did not know that. That is where that balance would be in a will or trust, where that provision would be. And fourth, but not least, even though it is probably not going to happen, a good estate plan is going to have what I would call an ultimate beneficiary or a remote contingent distribution. Now, this would normally be the what if all else fails provision? What if none of the beneficiaries are in existence? Let's say there were individual beneficiaries in your will or trust, but God forbid those people passed away. This ultimate provision or remote provision is going to be the provision that will address, in many people's cases, a charitable beneficiary. Now, that's not the focus of our presentation today, because we're talking about proactively giving to charity and being philanthropic. But this is something that I want to make you aware of, that in most wills or trusts, this can be a powerful tool to say, even notwithstanding what my other desires and my other goals are, if I pass away and there's no one to take my estate, otherwise, I leave it to these charities or to a charity. Now, we won't spend too much time on this because it's probably not going to happen. But when and if it did happen, that charitable organization would get money and funds. And for those of you who are interested in this, I mentioned just a few minutes ago that if you were a person that would allow yourself to be recognized by your charitable organization or organizations, that's a completely personal thing on your part. If you allow yourself to receive this recognition, then they can promote, they meaning the charity, can promote that you are a donor, even if it's in this backdoor way through a remote provision. And by doing so, it will actually help them promote more donors and to obtain more donors and to be more profitable. So in a strange way, it can help your charitable organization to be more thought of as far as people that are also interested in donating. All right, so we've talked about having a planning team. We've talked about the elements of a will or trust. And now let's go to the next slide, which is the methods of giving. And this is by no means an exhaustive list. But first of all, let's talk about the simple things. Let's talk about outright gifts. Cash, checks, credit cards. Let's not forget about that. That's a very, very powerful and simple way of giving. Testamentary gifts. One of our participants this morning asked the question, what happens at death? You know, when I give my property at my death? Well, a testamentary gift is exactly what we just talked about. In the residuary or in the specific gift portion of a will or trust, giving those gifts at death through a document. And the basic documents, as we know, are wills and revocable living trust. Remember, a revocable living trust is nothing more than a substitute for a will. It is not a rocket science. It is not a mysterious. It is simply an alternative to a will. And you can do some wonderful planning with wills or trusts, as well as outright gifts. Gift annuity, some of you will want to have a stream of income by giving or purchasing, I guess, a gift annuity. This is kind of an old-fashioned way of giving, and it's perfectly valid. Charitable trusts, there are charitable remainder trusts. There are many varieties of these, and there are charitable lead trusts. So a charitable trust, such as a charitable remainder trust, is a trust where you contribute property during your life, and that property is going to be held in that trust, and it's going to produce an income stream. We're going to see this in a little bit more detail. It's going to produce an income stream for you, your spouse, and perhaps even others like children. And then at your passing, or when that trust ends, it's going to go to charity. So this is going to give you a current income tax deduction, which we're going to see, and also a charitable, an unlimited charitable deduction of the remainder interest. Now, in a charitable lead trust, which for some donors, this is going to be more advantageous under certain economic conditions, depending on the 75/20 rates and so forth. This is going to be a situation where a charity will be the lead person or the lead organization to receive the charitable income, and then the balance would go to family members. So these charitable trusts are tried and true in the sense that the IRS code provides for these. There doesn't seem to be any ambiguity, and these are still very, very viable tools that our government encourages, not only amongst all of these other methods, but in and of itself allows for the use of these charitable trusts. Now, some people don't want to establish a charitable trust, so they will establish a donor advised fund. And many of you on this webinar this morning understand what these are, their flexibility, the ability to create them without having to create a charitable trust, although they are not exactly the same thing, but they provide wonderful flexibility no matter where your broker dealer has this, or your institution provides these for you. So we're going to get into that just a little bit more. Retirement plan contributions, qualified charitable distributions in 2023, as many of you are aware, although it's not deductible for gift tax purposes, it is a wonderful tool to be able to give from your IRA up to $100,000 for a single person, up to $200,000 for a couple, to be able to simply be able to give straight from the IRA to the charitable organization of your choice. And it is not going to cause income tax to you individually to be able to do that. So this is a wonderful tool. And I'm going to go as far as to say that by my fault, I should have added another bullet point here that just simply said retirement plan beneficiary designations to charity. So not only do we have these qualified charitable distributions that are still being allowed, and I understand they will be allowed through 2024 and hopefully beyond, because it's a wonderful way to be able to give. But I want to stop for just a second and talk about being able to beneficiary designate retirement plans straight to charity. So Natalie Choate, who is, I don't know if she's near retirement, but she is the grand master in our world of estate planning of how to leave retirement assets through estate plans, and also talking about charitable giving. And one of the things that Mrs. Choate, among many other things, does is she advocates for keeping things simple in many cases, especially when it comes to retirement plans, and for non-Roth IRAs that are given to charity, where we simply designate the IRA straight to a charitable organization. It's going from point A to point B. This is sometimes the most beautiful method of giving, because the charity is going to receive that retirement plan with no income tax. So if you're looking at a situation where you're choosing between individual beneficiaries and charitable beneficiaries to receive your retirement plans, and if you have other non-retirement assets, it could be that you're going to decide that the gift would be more powerful to give the retirement plan to charity versus the individuals. And of course, every person is different, but the individuals will pay income tax on a traditional IRA, but the charitable organization will not. So some people will get all in the weeds about leaving retirement plans through a trust and other more complicated methods. But again, we want to get into the mechanics of those more powerful methods or more complex methods. But maybe it's more powerful in many cases simply to go from point A to point B and not risk the implosion of an IRA where all the tax might be payable through trying to be too complex by leaving IRA money through a trust where it could cause taxation if it's not done perfectly prior to getting to charity. So if we're going to leave an IRA to charity, we certainly don't want to trigger income tax before it gets there, because the beauty of it is the charity does not pay any income tax. Now, the private foundation, I believe someone that's participating here this morning had mentioned a private foundation. A private foundation can be established. Charles Borick, who is one of our special counsel attorneys here at Elville and Associates, is a member of the For Purpose Law Group. The For Purpose Law Group is out of San Diego, California, and we are very privileged to be affiliated with them as our special counsel attorneys. And Charles Borick has written many books. So Charles is an expert in charitable giving. And if you have questions about establishing a foundation, he could actually very efficiently advise you on these things, and we will facilitate that for you. Volunteering. Volunteering is a method of giving. So I know that's not the focus of today's discussion, but just remember that you giving of yourself to a board of directors or to the mechanics of an organization to help them further their cause is a method of giving. Now, what are the tax advantages, even though we said this was kind of down the list? Well, we talked about the qualified charitable distributions and how it reduces taxable income because we can give up to those amounts I mentioned straight from an IRA. So what we have, depending on the strategy that you utilize, is there can be a current income tax deduction. So for example, a person who creates a charitable remainder trust and contributes property, which we're going to give an example here in a few minutes, that person is going to get a current lifetime income tax deduction, not just a charitable deduction eventually, but a lifetime income tax deduction. So the person who asked the question, should I, give during life? What would be the reasons to do that? This might be one of those reasons. Cash contributions are deductible up to 60% of adjusted gross income in 2023. For appreciated assets such as stock, it's 30% of adjusted gross income. What you need to do in conjunction with what I will call your advisory team is to decide your approach. Do I itemize? Do I not itemize? Do I bunch gifts? You'll see that down here. There are strategies about being able to get a bigger bang from your bunching of gifts in 1 year versus doing it each consecutive year. We're going to talk about an unlimited estate tax charitable deduction here. That is where we are able to have our estate reduced dollar for dollar. So let's say you are a high net worth person and you might have otherwise paid estate tax. We're going to talk about the estate tax exemptions here in just a moment, but you can, through the use of the unlimited charitable deduction, arrange your estate in such a way that you just eliminated the estate tax for federal and Maryland purposes if you're a Maryland resident. So these are just at a very high overview, some of the tax advantages of philanthropy. But one of the reasons for the advisory team is because we want to have a good understanding of the different types of taxes and how does this relate to our overall estate plan. So today we're focused on charitable giving and philanthropy, but we don't want to look at it, in my opinion, in a vacuum. Especially when we are juxtaposing lifetime gifts versus gifts at death, we want to have a team that is looking at our capital gains issues, our gift tax issues, our estate tax issues, and we talked about the 75-20 interest rates that have to do with more sophisticated planning, how that all relates. We don't want to be looking at this in a vacuum. Now, with that said, the very generous person who contributed their thoughts earlier and said, I'm leaving everything to charity. In some cases, it's very clear. We're keeping things very straightforward. There's possibly no need for this more advanced analysis, but overall, we want to be aware, because in today's world, we have access to so much information. And in relation to the changes that are ongoing, the politics, the social issues, the changes in the laws, we want to have a team, in my opinion, that is acting at the highest and best purposes on your behalf.
Steve?
Yes, Jeff.
Would now be a good time to pause for a couple of comments and questions?
Very much, and I'll have a sip of water. Thank you.
Sounds great. So going back to your recent pause, there were a couple of thoughts about that. And the first thought was to be supportive of an organization's objectives. And then our other attendee had several thoughts. Experience of need. The money is not needed by heirs. A desire to be the solution. I like that one. And then a business tax advantage. So several good thoughts there. And then,
yes.
And then a question, can I give to a charitable organization from my RMD, from my IRA, and claim a deduction?
Thank you for that. The first part, the answer to the first part is yes. The second part is the answer would be no with regard to any kind of estate or gift tax deduction. So I believe that is the answer to that question. And if you will please email me offline more specifically, I'll be happy to get you an answer to that. But I believe the answer is yes and no.
Okay, that's it for now. Thank you.
All right, thank you for sharing, Jeff. Well, I'll tell you, I'm going to think about that comment, Jeff, all of those comments, but the one Jeff just made, I'm going to put that on my computer so I can see it. Desire to be the solution. I really love that. Thank you for that. All right, so we're dealing in a world now where we are seeing from an estate and gift tax perspective higher exemptions than we've ever seen. 12,920,000 for each individual on the federal level. Almost 26 million between a couple that can be exempted for estate tax. And for gifts, and we're talking now about non-charitable gifts, and this is really how we want to have this idea of what's really happening here. We don't want to get caught up in the ambiguity. So when we're saying that we have an estate and gift tax exemption, that means that we have a limit on how much we can give to non-charitable causes or to individuals. So we can give up to $17,000 per person per year. That is the annual exclusion from gift tax. That is not charitable related. That's the annual exclusion from gift tax from ourselves to another individual. Okay, so now Uncle Sam says, well, if you go beyond $17,000 per person per year, and remember it's going to be $18,000 most likely next year, now Uncle Sam is going to start counting. Uncle Sam on the federal level is going to say, well, if you made a $100,000 gift, you've actually made an $83,000 taxable gift. That means that you were able to give $17,000 for free, so to speak, but now Uncle Sam counts the extra $83,000. No taxes due in most cases, but that $83,000 gets deducted from your $12,920,000 exemption. So in other words, you can use your exemption during life, but the thing I want you to know from this slide here is that this has nothing to do with the unlimited charitable deduction, okay? So in other words, if you were to die and leave your estate, like the one participant said, all to charity, then that is going to be a 100% charitable estate tax deduction at your death. And so these exemptions, the only reason I'm pointing them out is for a few reasons. One, I want you to see what they are. And the Maryland exemption is $5 million per person, or through the use of portability, $10 million. So $12,900,000 for federal, $26 million overall, even though on the federal level, these are going to reduce in 2026 if the legislation is not changed to the sunset. That sunset kicks in 2026. These are going to be reduced to approximately $6.8 million per person. But this has nothing to do, when you hear this, This has nothing to do with your gift tax unlimited charitable deduction at death, or the estate tax charitable deduction. So Maryland has no gift tax, but remember that relates to individuals. It does not relate to charities. So just want to say these estate and gift tax exemptions are out there. They're part of our overall planning. They're part of our overall knowledge. So for example, let's say you weren't leaving everything to charity at your death. You had planned for great gifts to charity, but it's really from your heart, it's from your compassion to be the solution. But as a net result of it, it reduces your taxable estate. It has nothing to do with the estate and gift tax exemptions that we deal with routinely on a daily basis. It's a different thing. It's a different kind of estate charitable deduction. So we have volunteering and outright donations. We talked about this. Many of you do this already. You distribute property, you distribute your time, you distribute yourself as the solution, so to speak. So obviously this is part of the mechanics, but it's also part of the philosophy of what you do. Now, a charitable gift annuity, as we mentioned, is a contract between you and the charity, and you have an income, that tax deduction, and a stream of income. This is a rather old-fashioned approach. Many of you believe in this. Many of you have done this. There's absolutely nothing wrong with it, but I just want to show you this is still available, and many organizations believe in this and issue these gift annuities. A charitable lead trust, as I mentioned earlier, is it comes in a couple of different varieties. A charitable lead annuity trust, a charitable lead unit trust. Basically what this is it's a trust that makes payments to charities for a certain period of time, and the balance is paid to the beneficiaries, which can include yourself if you are so inclined to establish this during your life. A charitable remainder trust, which is generally more popular, is a trust that provides payments to the non-charitable beneficiaries for a period of time, 5, 10, 15, 20 years, or over a measuring lifetime. And the balance at the death of the lifetime beneficiaries or at the end of the trust gets paid to charity. Now, what is the big advantage of this for a lot of people? So for you, let's say that you owned a piece of property or you owned a stock, and that stock or property had a very low tax basis. You had paid $100,000 for this and it was worth $500,000. Well, if you contribute that to a charitable remainder trust, you can sell that property or stock with no capital gain and then enjoy an income from it, and then it can actually benefit charity at your death or at the end of the trust, and your estate will get a charitable remainder deduction of a certain amount. These calculations have to be crunched. In the world of estate planning, there are a couple of big software packages that we can crunch these numbers and give you an idea. This is all very mechanical, and it's allowed by the IRS, and it's something that you can take advantage of. I will say, even though it's beyond the scope of today's discussion, I'll say another thing that can actually be applicable to charitable remainder trusts, and that is because of the Secure Act, which is it's another subject for another day. Many of you might, if you're charitably inclined, say, well, I want to provide an IRA stretch out as long as I possibly can for some of my individual beneficiaries. Because of the Secure Act, I would have left an IRA to that person, but now because of the Secure Act, that person has to take all the money out in 10 years. All the taxation has occurred in 10 years, not good. But through the use of a charitable remainder trust for the right person who is charitably inclined, you can leave an IRA to the charitable remainder trust, and you may be able to achieve a much longer stretch out. It's not exactly the same thing, but you can achieve a stretch out of sorts for the lifetime individual beneficiaries greater than 10 years. And then perhaps in your situation, this would accomplish a goal of leaving assets to charity, but also accomplishing a greater stretch out. So that's going to be for the charitable minded person only, and only it's going to be situational, but I wanted to bring that up as a possible strategy for you. So the charitable remainder trust, as I mentioned, it has tax applications, it has income ramifications. Obviously, the more income that is retained for the donor and the donor's spouse, if married, and the donor's children, the more income, the less charitable deduction is going to be in the remainder to charity. In other words, the smaller the remainder will be. Whereas the less income that is taken during life, the greater the remainder interest would be, and the greater the charitable deduction would be. So pros and cons, this is good for a person who, again, has low basis assets that they wish to donate. They donate this to the charitable trust, and therefore it can be sold with no capital gain, and then be able to retain an income, get a current income tax deduction, and also attain a charitable remainder deduction, depending on what the numbers crunch out to be, depending on the length of the income and the size of the gift. Private foundations, we talked about this. Some of you are very, very highly motivated to have a foundation that exists for a particular purpose. These are wonderful tools as juxtaposed against simpler solutions such as donor advised funds and so forth. But Charles Borick and our special counsel attorneys here are happy to discuss this with you. And I will say he is extremely efficient, and the For-Purpose Law Group is very efficient in creating foundations that otherwise are sometimes very complex and very expensive. So my experience with our special counsel attorneys in this area is that this is a very efficient thing that they are well versed to be able to establish. We talked about this earlier. We have lifetime aspects of retirement plan assets like IRAs for qualified charitable distributions. We also have a death aspect of this, leaving this retirement asset straight to charity or straight to a charitable remainder trust. But Natalie Choate would argue, among other things, keep it simple. Now, that's not always going to be the case, but if we want to see the beauty of how this blossoms, where the charitable organization gift is much more powerful than leaving that IRA to an individual who has to pay income tax on that, that can be just a wonderful thing that you have a lot of satisfaction in doing. So retirement plan assets, even though they're very different, they have to be treated a certain way. They cause much anxiety and conjecture because they're a very different kind of asset. A very powerful tool in charitable planning if you are so inclined. The donor advised fund is not a separate charitable entity. It is a segregated fund, and it's just a wonderful tool that some of you are using to set up your own donor advised fund and leave assets to it from your own estate, as well as distribute assets or contribute assets to it during your lifetime. So those of you who already have this, I'm not going to go into great detail. Those of you who do not have a donor advised fund, we're happy to talk to you about that, but more importantly, talk with you in a team environment, including your financial advisor who can advise you further about how to establish this wonderful tool. So we want to be creative, not necessarily complex, although it can be. And remember, we want to have a design. We want to understand the elements of estate planning. So I talked about that a little bit earlier. How does charitable planning fit into those elements? We want to collaborate with an advisory team. That's going to depend on your situation and your personal thoughts, your goals. We're going to determine what level of involvement that you need to have. Some people don't want recognition. They don't want involvement. They don't want control. Some people do. Some people want to plan during life and give during life. Some people want to give only at death. So this is a counseling issue. This is a taking time to think issue. Jeff and I have talked about, and our team here has talked about for many years. One of the greatest gifts we can give clients is the ability to think, the time to think, and giving them the tools to make decisions, decisions that are advised well, but getting to where we want to go by thinking. Personal discussions with the charitable organizations. This is something that's very personal to you. Again, we talked about recognition. Is this something that you would shy away from, or Is it something that you would say, yes, I believe that my recognition actually helps the organization or organizations of my choice to actually make more money? Taking the Secure Act into consideration, which I just mentioned, using a charitable remainder trust as a way to get around the income taxation of the Secure Act, or being able to achieve a little bit more of a stretch for your lifetime beneficiaries if you do have individual beneficiaries, and understanding those charitable giving structures. Okay, this is how you can be more creative, or we simply don't have to get into all of this creativity and be more straightforward and very simplistic in our thinking. Now, again, keeping it simple, I'm repeating myself intentionally here. Direct IRA gifts to charity at death, huge bang for the buck. Outright gifts, very simple. Donor advised funds, very simple. And believe it or not, because the IRS does very clearly structure how lawyers have to establish charitable remainder trust, and the rules are very clear. The private letter rulings are very clear. These are actually simple structures overall, but this is what I would define as keeping it simple. So we encourage you, we've been going now for a little bit less than an hour, but almost an hour, very intense involvement on your part. I want you to think about securing your own legacy, if you haven't done it already, and have your documents reviewed, even if you've established your direction, just to double check yourself and see, you know, am I completely accomplishing what I wanted, or I didn't know I could do this? And again, I strongly encourage you to have a planning team as you think about your total legacy. So what are the next steps, and how do I determine, like one person I think almost asked this question, how do I determine if I'm in a position to give now, to give at death? How do I do that? Well, it's all counseling. So let's talk about the path forward. And what I would like to just offer here is we're here to help. We're here to consult. Our estate planning or charitable planning consultations are generally free. We usually take about an hour to an hour and a half to consult. We suggest that you bring an estate planning questionnaire. We can send that to you, or advisors on the line here today, we can make that questionnaire available to you. There's, you know, sometimes an uncomfortable thing of sharing information with strangers, such as lawyers and other advisors. So we encourage you to relax, because there's nothing to fear because of the attorney-client relationship. Even if you don't engage a law firm to move forward and represent you after a consultation, that initial consultation is it's subject to the attorney-client privilege. It is confidential, and it is it's sacred. So that information is very confidential. There's nothing to fear. We'd like to look at your current estate planning documents, so please bring those. We generally don't charge to review documents, and we can review documents fairly quickly. We want you to consider having an advisory team, as we've mentioned several times. We want you to bring questions. Many of you today participated. We very much appreciate that. Bring your questions. We love having those questions that we can help get down to what is really of concern to you. And as I mentioned a few minutes ago, we here at Elville and Associates, and I'm sure your advisory team would agree, we want to take the time to think. We want to decide what our goals are. And obviously some of you already know those, but if you don't know what your goals are, we can help you have an epiphany of sorts as you're going through the process to determine what your goals or further goals really are. So I thank everyone today for being here. We've kept it to about an hour, and it's looking very beautiful outside, especially after last night here in Maryland area. And Jeff, I'm going to turn it back to you. I thank everyone for participating and your compassion, your interest in philanthropic giving, and for supporting our webinar series.
Well, thank you, Steve. It's great to see the sun out again. I can see it through my blinds here. And as we talk about giving and compassion, we see the sun come out. So I think that's not a coincidence. So that's a good thing. So now would certainly be your time to get any final questions that you have for Steve into me. I would certainly appreciate that, so I can get those over to Steve. As we wait for any final questions, we'll talk just for a moment about our upcoming presentations. This was presentation that we haven't offered for a good while, but as we move forward here, we have our quarterly Understanding Estate and Trust Administration webinar on Friday at 10 o'clock with Steve. And then on October 11th, we have a presentation that we offered at a local continuing care retirement community that was extremely well received. And so we are offering it in our webinar series, The Critical Need to Update Your Estate Planning, and something that we talk a lot about here in general terms and some other presentations, but we paired it into its own presentation. So we will dive deep and talk a lot about that on October 11th at 10 with Steve. Also, I wanted to mention our annual client and community education event is fast approaching. We have been talking about it and preparing for it for about 8 months, and it is here November 4th from 8:30 to noon at 10 Oaks Ballroom in Clarksville. We have a very, very large crowd, and we are so excited. We hope you'll join us. You don't have to be a client. We have clients, financial advisors, interested community members that are attending. It is a fun, friendly, warm, educational experience. We have live music, educational presentations, great food, lots and lots of door prizes. I'll be emceeing the event, which I enjoy doing. I've been doing it for 8 or 9 years at this point, and some more surprises along the way. So we hope you'll be joining us. If you're on this webinar, more than likely you received an invitation. If you have any questions whatsoever, just give me a call, email me. I'll be happy to share a lot about the event with you. So last day to RSVP for that is October 18th. So please don't hesitate in doing that. We still have room as the place seats 400 people. We're not there yet. We might be though. So anyway, look forward to seeing you there. So we'll see if we have any final questions here. And looks like we do. Okay, very good. First question is, besides a tax deduction, do you know any advantage reason to donate to an organization like the Red Cross?
Well, that is a great question. I think it's a very broad question. I think the Red Cross is going to be one of those, if I could just make this up, a grade A or class A organization, I would imagine. And so I think this is going to be, for some people, this is going to reach very much to the heart of the goal. The goal is to support the Red Cross because of their mission, right? And so I would encourage you to start doing some research about the mission of the Red Cross. And then as you look to, that organization, you may say, yes, that's what I want to do here because of their particular mission. But of course, in today's world, because of the proliferation of wealth and also the proliferation of the internet, there are many causes out there with different missions. So I would say, yes, above and beyond the tax deduction, you're going to want to be, in my opinion, mission driven, in purpose driven. And I think this has to do with your intention, your intentionality. What I'm intentionally doing this and why. Okay, so yes, I think you to me are in search of finding your intention in giving. You know what the tax advantages are, but now what is my intention?
Okay. Next, if leaving money in an estate to a non-family individual in Maryland, does that person have to pay tax?
That's a great question. So in Maryland, we do have an inheritance tax. So above and beyond estate tax and gift tax and generation skipping tax and income tax, Maryland has an inheritance tax of roughly 10%. But that inheritance tax has been eliminated for lineal descendants, basically. But if you leave assets to someone like who is not a lineal descendant and subject to the current law, that person is likely going to be subject to inheritance tax of 10%.
Okay. And looks like the last question for now is, if you could repeat, please, the difference between a donor advised fund and a foundation.
Well, that's a great question in and of itself. So I won't be able to articulate all the differences, but I would just say that a donor advised fund, and I don't mean to draw a a relationship between the two, but I'm simply saying that some people will want to fund and run after their passing or even during life a foundation. And that foundation is going to be a formal entity. It has its own rules, strict rules, and it has to be run a certain way. The donor advised fund is a more casual, if you don't mind me using that word, way of establishing charitable intentions to funnel money to certain causes through the wonderful networks of the financial advisory firms that are out there that have these donor advised funds, and you can customize one for yourself. So what I would say is the difference would be among many things, but I think one of the most basic differences is just the formality of it. The formality of a private foundation is, I'm going to say, a tremendously high formality and requirements and reporting requirements. The donor advised fund is going to be more informal. And some of our advisors here on the call today could go into much greater detail about it as far as that particular aspect of it. But that's how I would look at it, is that it's an informal way for you to be able to establish quite a robust giving tool versus having a formal, let's say, a more entity that would last in perpetuity.
Okay, excellent. Thank you very much. Looks like those are all of our questions for right now. We are really appreciative of your interest in our Elville webinar series and Elville and Associates in general. If there's anything we can do for you, please reach out to us. We really look forward to seeing you in our office sometime soon or on another presentation coming up soon. So thank you again and hope you enjoy your day. We'll see you again. Thanks again.
Thank you.